discusses some of the uses of futures. If you observe the markets, the dollar volume of shares in futures contracts far exceeds the dollar volume of direct trading in the assets themselves. So futures written on those assets like bonds, stock indexes, and so on are traded much more frequently. And it all boils down to one important factor about futures contracts is the trading markets for futures contracts are highly liquid and involve very low transaction costs. So highly liquid means you can get in and out of a position very easily. There's always buyers and sellers on either side willing to make those transactions that you are looking to do, and there's not too many costs involved in doing so. So futures have become highly used in different avenues. One of the main ones is in hedging. Okay, what is hedging? So if we're talking of hedging using futures, it is the use of financial futures to reduce the type of risk that the buyer or seller is subject to. Okay, so we're trying to just reduce the risk of a portfolio's value changing by using futures to do so. Okay, for example, let's say there's a corporation who's about to sell a long-term issue of bonds. Now the corporation, the people in charge of that are worried about the interest rate changing that is going to cause them to lose value using their bonds. Okay, the interest rate changes, which means that they might have to pay a higher rate to sell their bonds. So how can they avoid the risk of interest rate changes affecting them? So they could at the same time also sell a futures contract on a similar amount of long-term government bonds. They sell a futures contract, and in that sense, they've essentially locked in the interest rate. Okay, how do they do that? So let's say the interest rate does go up as the firm was worried about that happening. Now, if the interest rate does go up, they're going to pay a higher interest rate to sell their bonds. Okay, the corporation is going to do that. However, at the same time, the value of the short position in the futures contract has gone up by a similar amount. Okay, so now they've lost some amount by them having to pay a higher rate to sell their bonds, but at the same time they've gained some amount through their short position. Okay, on the overall, that kind of offsets each other. Okay, and hence why we say we essentially lock in the interest rate. Okay, they offset each other, which means eventually, based on the combination of these two factors, the interest rates haven't changed too much for the firm on the overall, and they have not lost too much money. Okay, they've kind of offset their losses. However, that might not be a dollar for dollar movement. Okay, as in if they're losing $10 in value through the bond position, they may not gain exactly $10 back. Okay, to completely offset. And what causes that? That is happening due to basis risk. Okay, basis risk. This is an important concept. What is basis risk in the terms of bonds? Okay, it's the risk that the spot price of the firm's corporate bonds and the future price of government bonds do not move exactly alike. Okay, they may move in similar ways, but not in identical ways. Okay, they may not move exactly one for one. So one might move at a faster or slower pace, and that causes differences in how the offsetting works. Okay, so basically, if rates increase, both prices will go down. So remember that rates and bond prices are inversely related. If rates go up, bonds prices have to go down. They both do go down, but they may not go by the exact same amount. They might go down by different amounts. Okay. Now, let's say we have a portfolio and we're worried about the diversified portfolio losing money. Okay. If a lot of our investments are in the market and we're trying to avoid market changes from dramatically changing the value of our portfolio. In that case, we can sell futures on a diversified portfolio like the S&P 500, an index future. Okay, and that will hedge away the risk that changes in the stock market can dramatically alter the value of our portfolio. So we're actually going to do a full example about this in a future video. But for now, all you got to know is in order to avoid the stock market changes from dramatically affecting portfolio value, we can short or sell index futures on a diversified portfolio like the S&P 500. Now, based on that, The second use that we can talk about is changing investment policy. Okay, it kind of relates again. Everything relates back to the fact that there are lower transaction costs and a highly liquid. That futures markets are highly liquid, and so what can we do if we're trying to change our investment policy? Okay, let's say we want to change the market exposure of a stock portfolio. So a manager of a mutual fund has a beta of 1.5 for that portfolio. What does a beta 1.5 mean then? A beta 1.5 means if the market changes by 1%, then our portfolio, due to that beta 1.5, will actually change by 1.5%. Okay, so if the market is going up, a 1% increase in the market leads to 1% increase in our portfolio. But at the same time, if the market drops, we're going to drop by an amount that's greater than the market. Okay, now assume the manager believes that the market will drop and wants to thus reduce the exposure. Okay, you want to reduce your beta in order to reduce the exposure to that drop. Okay, so how can you go about doing that? The manager has two options. The first option is the manager can sell high beta stocks and purchase low beta stocks or T-bills. Okay, and that should reduce the beta because you've gotten rid of the high beta stocks. However, what are the issues associated with that? Selling these assets, these direct assets, involve high transaction costs. Okay, there's high transaction costs associated with this. And the other issue is you might actually reduce the contribution of selection ability to that performance. Okay, you're reducing the different assets that contribute to your portfolio. Okay, now these high transaction costs are not good for a firm because you want to minimize the costs associated with getting in and out of positions. What helps us do that? The use of futures. Okay, so if we sell stock index futures, the combination of the existing portfolio and those futures positions actually has a lower beta. Okay, so now what have we done? Our portfolio can still stay as is. Okay, but at the same time, now we have lower transaction costs because we've achieved our goal of reducing beta through futures. Okay, through shorting futures. Now let's say we're a bond manager. Okay, we want to change interest rate exposure on our bond portfolio. Okay, we're basically going to be looking at bond duration. This is an important concept. What is bond duration? Okay, it's the measure of the sensitivity of bond portfolios to changes in interest rates. Okay, that's the definition of bond duration. Okay, so what are bond managers? Okay, bond managers are timers basically. That's what they're doing. Okay, they're forecasting the future course of interest rates. Okay, based on the future course of interest rates, they're changing the maturity of their portfolios to account for that. Okay. Now, what could they do? Okay, so transaction costs of liquid government bonds are substantially less than thinly traded corporate bonds or government bonds. Okay, so the bond managers want to be able to reduce their maturity very quickly. Okay, so basically you need to read the textbook and make sure that you understand what bond managers would do if they forecast a higher interest rate or if they forecast a lower interest rate than what they anticipated. Okay, if they feel that rates will rise more than they had previously anticipated, they tend to shorten the maturity of their portfolio. Okay, if they feel that rates will fall more than they had anticipated, the maturity will be lengthened. Okay, so we need to do something in order to shorten or lengthen the maturity of our portfolio. Okay, so we're going to use assets or different bonds to be able to do that. Okay, so what they have to do now is they could be holding very high return bonds in their portfolio, but they're going to have to change that to actually holding very liquid government bonds as a large part of their portfolio in order to be able to get in and out of positions very easily. Okay, so they're giving up greater expected returns of corporate bonds in favor of lower transaction costs. Okay, they're leaving out these high return bonds in order to get lower transaction costs. Okay, which is not an optimal decision in the terms of the manager. However, what can we do to avoid these high transaction costs? As you've seen a trend over this discussion, futures can accomplish the same goal without constraining them to hold lower return securities. Okay, we could still hold the same securities while at the same time reducing our exposure to interest rates. Okay, so if we want to shorten our duration, futures contracts are going to be sold. Okay, for example, think about a 1-year future on a treasury bond when treasury bonds are held in the portfolio. Okay, in this case, we've shortened our duration to 1 year basically. Okay, now the last use we could have for, well, there are many uses. Okay, the last use in this textbook discussion is if we want to change our stock bond mix. Okay, we could use futures to do that. If we want to change exposure to the stock or bond market, we've already talked about how the exposure to the stock market can be changed. In that case, we wanted to reduce our exposure to the stock market, so we sold futures, or we went short on a futures contract. Now, let's say we want to increase the beta. Okay, if we purchase stock index futures, we will increase the beta, and with that, increase our stock market exposure. Okay, similarly, if we're selling bond futures, we're going to decrease the duration of our bond portfolio, or of our portfolio, and we're reducing the exposure to interest rate changes. Okay, these are the main uses that we've discussed in general of futures contracts. In the next video, I'm going to solve an example of how to hedge using index futures.